Imagine you are making a significant financial commitment, one that requires a certain amount of patience and understanding of the rules. When exploring the world of alternative investments, particularly hedge funds, you might encounter terms that define how and when you can access your capital. One such critical term is the lock-up period, a commitment that can significantly impact an investor's liquidity. To address the question directly, no, lock-up periods in hedge funds are not always the same. They exhibit considerable variation, reflecting the diverse strategies employed by different funds and the unique needs of their investment portfolios. This flexibility is a fundamental characteristic of the hedge fund landscape. The primary reason for this variability stems from the underlying investment strategies a hedge fund employs. Funds that invest in highly illiquid assets, such as certain private equity interests or distressed debt, naturally requiring longer lockup periods. This ensures that the fund manager is not forced to sell assets prematurely at unfavorable prices to meet redemption requests. Conversely, funds pursuing more liquid strategies, like global macro or long-short equity with easily tradable securities, might have shorter lockups or even none at all beyond an initial period. Another significant factor is the fund manager's need for stable capital. Longer lockups provide the manager with a predictable capital base, allowing them to execute their investment thesis without the constant pressure of investor withdrawals. This stability is crucial for long-term performance generation and managing complex positions. The specific terms are often negotiated between the general partner, who manages the fund, and the limited partners, who are the investors, taking into account the fund's operational needs and the investor's liquidity preferences. For an investor, understanding these variations is paramount. It is essential to thoroughly review the fund's offering memorandum or private placement memorandum, which details the specific lockup terms. Pay close attention to the initial lockup period, which specifies the time an investor cannot redeem any capital, and subsequent redemption gates or notice periods, which dictate how future withdrawals are managed. These documents will also outline any potential fees for early redemption, known as early redemption penalties. Beyond the initial lockup, investors should be aware of features like redemption gates, which limit the total amount of capital that can be withdrawn from a fund during any single redemption period. There are also notice periods, often 60 or 90 days, that investors must provide before a redemption can be processed. In some cases, especially with less liquid assets, a fund might utilize side pockets, segregating illiquid assets into a separate account with its own extended lockup or disposal timeline. Understanding these nuances, from hard lockups where no redemptions are allowed to soft lockups with penalties, provides a clearer picture of your capital's accessibility. Ultimately, the diversity in hedge fund lockup periods is a critical mechanism designed to align investor expectations with the liquidity profile of the fund's investments. By comprehending the why behind these structures and the how-to of identifying their specific terms, investors can make more informed decisions, ensuring their investment strategy remains in harmony with their liquidity needs and the fund's operational realities. This deep understanding fosters a more successful and predictable investment journey within the alternative asset landscape.